Before you invest a single dollar into a meal event, to say, not because the market is dangerous, but because you might be walking into it blind. People don't fail because of bad investments. People fail because they don't understand themselves. 2026 is not a year for gamblers. It's just a year for thinkers. Most people enter the world of investing with excitement, but they carry something far more dangerous than inexperience. They carry emotion. And emotion, when mixed with money, becomes a silent enemy. Fear, greed, impatience, insecurity, overconfidence. These feelings don't just influence investing decisions, they distort them. They turn smart people into reckless gamblers and long-term thinkers into short-term reactors. When someone invests emotionally, they're no longer analyzing opportunities, they're chasing them. They're no longer choosing wisely, they're hoping desperately. And hope is not a strategy. To invest intentionally means stepping out of that emotional whirlwind and entering a space where logic leads, not impulse. It's about slowing down the brain long enough to ask the right questions. Why am I buying this? Do I understand the business behind it? What problem does it solve? What gives it value? What could destroy it? When emotion leads, these questions never get asked. Instead, people look at price charts, follow hype, chase what's trending, and mistake momentum for meaning. They imagine a future profit and ignore the risk. They fear missing out and forget to think. Emotional investing is always reactive to news, to rumors, to sudden price movements, to what others are doing. Intentional investing is the opposite. It is proactive. You decide before the world decides for you. Consider the difference between the two investors standing at the edge of a market drop. The emotional investor sees a falling price and panics. Their heart beats fast. Their mind imagines disaster and they sell often at the worst possible time. The intentional investor sees the same drop and asks, has the value changed? Or only the price? If the value stays the same, the drop becomes an opportunity, not a threat. This single distinction, panic versus analysis, creates two entirely different outcomes. One locks in a loss. The other positions for a future gain. Greed works the same way. When markets surge and everyone around you talks about easy money, emotional investors jump in with the wrong mindset. If everyone is making money, I should too. They buy because others are buying, not because they understand what they're buying. This is how bubbles form. This is how people lose fortunes. Intentional investors refuse to be pushed around by a crowd. They study the fundamentals before the excitement. They build conviction before they commit capital. They are willing to miss fast profits, if it means avoiding foolish risks. They understand that wealth built on excitement disappears quickly, but wealth built on research tends to survive. Another trap of emotional investing is impatience. People want results immediately. When the value of their investment doesn't rise fast enough, doubt creeps in. They jump from one stock to another, from one strategy to the next, believing speed will compensate for lack of strategy. But impatience destroys returns. Investors who constantly chase the next opportunity never let their current one develop. Intentional investors understand that time is the most valuable asset in finance. They give their investments room to grow. They allow the compounding process to work. They know that real returns happen slowly, almost invisibly, until one day they appear suddenly and powerfully. Emotional investing also clouds judgment with personal bias. People invest in companies because they like the brand, admire the founder, or have a sentimental connection, none of which guarantee financial success. Intentional investing demands that personal feelings step aside. A great product does not always mean a great business. A popular company does not always mean a profitable one. When you invest intentionally, you evaluate with clarity, not affection. You understand that the market doesn't reward what you like, it rewards what works. Above all, emotional investing makes you vulnerable. Every headline becomes a threat. Every market fluctuation feels personal. Every rumor sparks anxiety. Intentional investing protects you from that instability. When you invest intentionally, you build a strategy you understand. You create rules you follow. You create a plan that stands firm regardless of temporary noise. And because your decisions are rooted in knowledge, they are not shaken by fear. The truth is simple. Investing emotionally creates chaos, but investing intentionally creates control. Emotion promises excitement, but intentionality promises stability. Emotion pushes you to react, but intentionality teaches you to think. In the long run, success is not earned by those who feel the strongest. It's earned by those who think the clearest. 2026 will be a year that exposes a major truth. Many people don't want to hear in investing, speed is overrated. Discipline is everything. The world celebrates fast decisions, fast trades, fast profits. But the market does not reward speed, it rewards quality. It rewards patience. It rewards the investor who is willing to think slowly while others rush blindly. Most losses come not from lack of opportunity, but from rushing into opportunity without understanding it. And 2026 will magnify this more than ever. People often confuse activity with progress. They think the more trades they make, the more money they will earn. They think constantly jumping from stock to stock means they're on top of the market. But in reality, constant movement is usually a sign of insecurity, not intelligence. The investor who cannot sit still rarely wins. Markets punish those who chase constant excitement. In 2026, when markets become more unpredictable and information spreads faster than ever, rushing will become even more dangerous. A fast decision based on incomplete data, hype, or emotion can wipe out months or even years of gains. Discipline is what keeps you grounded when speed tries to push you off balance. The disciplined investor knows that real wealth is built during quiet periods, those long stretches of time when nothing exciting seems to be happening. These are the moments when most people get impatient, sell too early, or move into riskier investments because they want faster results. But discipline teaches you something powerful. Boredom in investing is often a sign that you're doing things right. If you want excitement, go to a casino. If you want wealth, stay patient. 2026 will challenge investors to stay committed through slow months, uncertain markets, and distracting noise. The ones who remain calm will outperform those who chase every fluctuation. Rushing also creates a dangerous illusion, the illusion that you're in control. When people make quick decisions, they believe they're being smart, decisive, or ahead of others. But rushing is usually just reacting to news, reacting to fear, reacting to opportunities other people talk about. The disciplined investor doesn't react, they respond. They allow information to settle, emotions to calm, and logic to take the lead. They don't fear missing out because they understand that missing a bad opportunity is just as important as catching a good one. Another danger of speed is that it blinds you to risk. When you rush, you only look at potential returns. You don't consider what could go wrong. You underestimate volatility. You ignore red flags. You believe optimism without questioning reality. But disciplined investors study both sides of the coin. They assess the upside, but they also evaluate the downside. They ask, if this goes wrong, can I tolerate the loss? This mindset protects them from catastrophic mistakes. In 2026, with rapid market swings and unpredictable economic shifts, this balanced approach will be essential. Discipline also brings something speed never can. Consistency. Anyone can make one lucky trade. Anyone can catch one good trend. But consistent success, year after year, belongs only to those who follow a disciplined process. They don't chase the hottest stock every month. They don't dump their investments based on rumors. They don't let emotions dictate their strategy. Instead, they create a plan and follow it. They build habits that reinforce patience. They invest in businesses they understand. They review their decisions calmly, not impulsively. This consistency compounds just like money does. Small, steady decisions accumulate into significant long-term results. 2026 will be filled with people shouting predictions, posting bold claims, and bragging about fast profits. Social media will amplify these voices, making you feel like everyone is getting rich quickly except you. This is where discipline will protect you. It helps you ignore the noise and stick to your path. It reminds you that highlight reels are not real life. For every person who claims they doubled their money overnight, thousands quietly lost theirs trying to do the same. Discipline keeps you focused on your own journey, not someone else's illusions. Speed tempts you. Discipline guides you. Speed excites your emotions. Discipline strengthens your judgment. Speed pushes you toward reckless decisions. Discipline leads you toward sustainable wealth. And as the markets evolve in 2026, these differences will become sharper, clearer, and more impactful. If you can master discipline in a fast world, you will stand out. You will make better choices, avoid costly mistakes, and build wealth that lasts. The investors who rush will chase short-term rewards and long-term regret. The ones who stay disciplined will capture long-term rewards and avoid short-term disasters. Too many people invest in things they don't understand, and they don't even realize the danger until it's too late. They buy because a friend mentioned it, because a video went viral, because the price suddenly surged, or because the crowd seems excited. But investing blindly is like walking into a dark room with your eyes closed and hoping nothing is sharp. Hope won't protect you. Excitement won't protect you. Only understanding will. When you invest in something you don't understand, you're not investing, you're gambling. And gamblers eventually lose. Understanding what you invest in isn't just about reading a few headlines or glancing at a chart. It means knowing what the company actually does, how it makes money, what drives its value, what risk could break it, and whether its future looks stronger than its present. If you can't explain all of this in simple words, then you're trusting something you shouldn't trust. Markets reward clarity, not confusion. They reward the person who takes the time to learn, not the person who rushes into something because it looks exciting. The biggest trap people fall into is mistaking popularity for safety. Just because everyone is talking about a stock, a cryptocurrency, or a new trend doesn't mean it's a good investment. Popularity is often a sign of speculation, not stability. When something gets too hyped, it becomes even more dangerous because people stop thinking. They assume crowd confidence equals real value, but the crowd is usually late. The crowd buys high and sells low. Following the crowd is the easiest way to lose money because the crowd is driven by emotion, not understanding. If you want to avoid their mistakes, you must demand understanding before commitment. Another danger comes when people misunderstand risk. They hear that something has made others rich and they jump in thinking they're next. They don't study the downside. They don't consider what would happen if things go wrong. They don't ask the most important question in investing. If this investment collapses, will I survive? When you don't understand the business, you also don't understand the risks. And what you don't understand can hurt you the most. True investors learn the full picture, good and bad, before they put in a single dollar. Understanding also means knowing what type of investor you are. Not every investment fits every person. Some investments require patience. Some require high risk tolerance. Some require technical knowledge or industry-specific insight. When people invest outside their circle of competence, they panic at the first sign of trouble because they don't know what's happening. Panic leads to selling at the worst possible moment. This is how wealth evaporates. But when you stay within what you understand, you develop confidence, not emotional confidence, but informed confidence. This allows you to stay calm during volatility because you know what you own and why you own it. There's also a psychological shift that happens when you understand your investments. You stop needing constant reassurance. You stop checking prices every hour. You stop relying on strangers for advice. You become independent because your decisions are based on knowledge, not on noise. When you don't understand your investments, everything feels chaotic. Every news article shakes you. Every red candle scares you. Every rumor influences you. But when you know the fundamentals, you stop reacting to temporary moves. You start thinking in years instead of days. People underestimate how much understanding strengthens discipline. When you know the true value of something, you won't sell it cheaply. When you understand the long-term potential, you won't panic during short-term dips. Understanding protects you from emotional mistakes. It gives you the ability to endure storms that shake weaker investors out of the market. In this way, understanding becomes a shield, one that keeps you steady while others fall apart. On the other hand, ignorance amplifies emotion. If you buy something without understanding it, every drop feels like disaster. Every rise feels like a sign to take quick profit. You are constantly reacting because you have no anchor. You're not following a strategy, you're following your nerves. And nerves make horrible financial decisions. The truth is simple but powerful. If you can't explain an investment clearly, you have no business owning it. Your future wealth depends on the clarity of your present decisions. Understanding is not optional. It's the foundation. You don't need to be an expert in everything, but you must be an expert in the things you invest your money in. Because when you understand your investments, you gain control. When you don't, the market controls you. And the market is not kind to the unprepared. In every generation of investors, there are two groups, those who are controlled by noise and those who rise above it. Noise is everywhere. It comes from news channels predicting doom every week, social media influencers making bold claims with no accountability, friends urging you to buy the next big thing, and markets that move up and down so fast that even experienced investors feel pressure. But noise is not information. Noise is distraction. And in 2026, with information spreading faster than ever, the ability to separate noise from knowledge will determine who succeeds and who fails. Noise triggers emotion. Knowledge builds confidence. Noise confuses you. Knowledge guides you. Noise pushes you to act fast. Knowledge teaches you to act right. Every investor must learn that the loudest voices are rarely the smartest. When you let noise influence your decisions, you're no longer following your own strategy. You're following someone else's fear or someone else's excitement. And neither of those things cares about your future. Many investors waste energy reacting to every headline. A single negative news story makes them panic. A sudden price jump makes them greedy. They constantly ask, what's happening today, when they should be asking, what matters in the long run? Headlines are written to grab attention, not to make you wealthy. Markets move every minute. But your goals are not measured in minutes, they're measured in years. When you chase daily noise, you abandon long-term thinking. And abandoning long-term thinking is one of the fastest ways to sabotage your own wealth. Knowledge, on the other hand, is rooted in understanding. It's built on studying fundamentals, learning how businesses operate, analyzing trends through facts, not hype, and knowing the reasons behind your investments. Knowledge makes you stable when the world around you feels unstable. When you know what you own and why you own it, short-term chaos doesn't scare you. You stop reacting to the market like a nervous passenger on a turbulent flight. You endure the bumps because you understand the aircraft, the pilot, and the destination. Noise creates pressure. It whispers that you're missing out. It makes you feel behind. It tells you that everyone else knows something you don't. But the truth is, most people who look confident online are just repeating what they heard somewhere else. They are not building knowledge. They're recycling noise. When you follow them, you're not learning. You're copying, and copying without understanding leads to regret. Separating noise from knowledge requires mental discipline. You must learn to pause before reacting. You must question everything. When you hear something alarming, ask, is this fact or speculation? Who benefits from spreading this message? What is the long-term impact, not just the short-term reaction? Noise exaggerates problems. Knowledge puts them in perspective. Noise also makes small issues look huge. Markets dip all the time. It's normal. But noise will make you believe every dip is a disaster. Knowledge teaches you that volatility is not a threat. It's the cost of admission for long-term growth. When you understand this, you stop panicking at red candles. You see opportunities instead of threats. You stop selling out of fear and start buying with clarity. One of the most dangerous forms of noise is crowd behavior. People love to move in groups because it feels safe. If everyone is buying, you feel like you should buy. If everyone is selling, you feel like you should sell. But the crowd is driven by emotion, not information. The crowd reacts instantly, not intelligently. And history shows that by the time the crowd starts talking loudly about something, the real opportunity is usually gone. If you want to avoid being swept away, you need to rely on knowledge, not on the volume of voices around you. Knowledge takes effort. You have to read, study, question, and understand. Noise takes no effort at all, you just absorb it. That's why most people fall for it. But effort is what separates good investors from lost investors. Knowledge gives you the ability to stand firm while others panic. It allows you to stay focused when others are distracted. It helps you recognize real opportunities while others chase illusions. When you choose knowledge over noise, you gain clarity. You gain control. You become the kind of investor who isn't shaken by rumors or trends. You think deeply, not quickly. You evaluate, not react. And in a world where everyone is screaming, the person who can remain quiet, calm, and informed will always make better decisions. Before anyone puts money into the market, they must build the foundation that supports every smart financial decision, strong principles. Without principles, investing becomes chaotic. You react instead of plan, you follow instead of think, and you depend on luck instead of discipline. The truth is simple. Your strategy doesn't matter if your principles are weak. You can choose good stocks, understand the market, and follow trends. But without solid financial fundamentals, you will eventually fail. Principles are the guardrails that keep you safe when the road gets unpredictable. And 2026 will test every investor's commitment to those guardrails. One of the most important principles is spending less than you earn. It sounds simple, but it's the foundation of financial survival. Many people try to invest while still living beyond their means. They use credit cards, take loans, and stretch themselves thin, hoping investments will save them. But investing is not a rescue plan. It is a growth strategy. You cannot grow what you do not have. When you consistently spend less than you earn, you create a buffer, money that can be saved, invested, and used to seize opportunities. Without this habit, every financial move becomes stressful. A single downturn becomes a crisis instead of an inconvenience. Wealth begins with discipline long before it begins with profit. Saving before investing is another critical principle. Some people skip saving because they want returns quickly. They think investing early will solve everything. But if you invest without savings, one emergency can force you to pull your money out at the worst possible time. Markets go up and down. Life throws surprises. Without savings, you will always be one unexpected event away from selling your investments prematurely. Saving gives you stability. It gives you breathing room. It protects your investments from being interrupted by real-life problems. When your savings are strong, your investments can grow undisturbed. Another essential principle is investing only in what you understand. Without this, you are guessing, and guessing is not a financial strategy. Understanding creates confidence and prevents costly mistakes. It keeps you from being manipulated by hype or scared by temporary market dips. When people violate this principle, they fall into traps, useless tokens, risky stocks, or trending assets they can't even explain. Principles protect you from your own curiosity and impulse. They remind you that not every opportunity is meant for you. Emotional control is a principle that separates real investors from short-term thrill seekers. It is easy to be rational when markets are calm. It's when fear rises, when prices drop, or when everyone around you is panicking that principles show their true power. Emotional investors behave like a roller coaster, up during excitement, crashing during fear. They buy high out of greed and sell low out of panic. Emotional control stops this destructive cycle. It forces you to stick to your plan instead of reacting to every headline. It allows you to see volatility as part of the journey rather than a threat. When you master your emotions, you master your financial destiny. Long-term thinking is also a principle, and it is one of the most important ones. Many people want quick returns, fast answers, and instant success. But wealth is rarely fast. It grows slowly and quietly, invisible at first, obvious later. Long-term thinking protects you from impatience. It reminds you that short-term fluctuations are the price you pay for long-term growth. It helps you stay focused on your goals rather than daily distractions. When you think long-term, you stop obsessing over today's price and start focusing on the value you believe in. You invest for years, not for minutes. These principles work together. When you spend less, you have money to save. When you save, you have money to invest. When you invest only in what you understand, you avoid unnecessary risks. When you control your emotions, you avoid destructive decisions. When you think long-term, you give your investments time to grow. Without these principles, the market becomes a battlefield. With them, it becomes an opportunity field. Many investors fail not because the market was bad, but because their principles were weak. They didn't have the discipline to control spending, the patience to save, the curiosity to learn, the strength to stay calm, or the maturity to think long-term. In 2026, as markets shift and uncertainty grows, these principles will matter more than ever. They will guide you through challenges, protect you from mistakes, and help you build wealth that lasts, not just wealth that looks good temporarily. Principles are not optional, they are the foundation beneath every successful investor. The stronger the foundation, the higher you can build. The weaker the foundation, the faster everything collapses. In the end, your principles determine your future more than any investment ever will. Success in investing rarely begins with charts, numbers, or predictions. It begins with the person you become before you ever put a dollar into the market. Your mindset shapes every choice you make, what you buy, when you sell, how you react, and how you grow. If your mindset is weak, the smartest strategy won't save you. If your mindset is strong, even a simple strategy can create extraordinary results. In 2026, this truth will become more obvious than ever. Markets will fluctuate, trends will come and go, and predictions will rise and fall. But the investors who succeed will be the ones who have trained their mind, not the ones who chase the latest opportunity. A strong mindset starts with self-awareness. You must understand your own strengths, weaknesses, fears, and tendencies. Some people are naturally anxious. They panic when prices dip. Others are naturally impulsive. They jump into investments without thinking. Some are overly confident, believing they can't fail. Others are too cautious, afraid to take any risk at all. When you don't understand yourself, the market exposes you. It pushes your weaknesses to the surface and forces you into decisions that hurt your future. But when you understand yourself, you know what triggers your mistakes. You know what environments lead you to bad choices. You learn how to protect yourself from yourself. Discipline is a mindset, not a mood. You cannot rely on motivation alone. Motivation fades, but discipline stays. When you're disciplined, you don't need the market to behave nicely for you to stay focused. You follow your plan because it's your plan, not because the world agrees with you. You save consistently even when it feels slow. You invest regularly even when you're tempted to wait for the perfect moment. You stay patient even when everyone around you is chasing shortcuts. A disciplined mindset gives you strength when emotions want to take over. Patience is another key part of the mindset that builds wealth. Most people fail because they want speed. They want results immediately. They want their investment to double in months, not years. But markets don't reward impatience, they reward endurance. They reward consistency. They reward the person who is willing to let time do the heavy lifting. A patient mindset allows you to sit through volatility without losing focus. It allows you to let compounding work silently in your favor. When others panic and sell, patience helps you hold. When others chase trends, patience helps you stay still. Wealth doesn't come from constantly moving, it comes from knowing when to sit and wait. A strong mindset also means accepting that you don't know everything. Humility is critical. People lose money when they believe they can predict the future with certainty. They assume their opinions are facts. They ignore new information because it challenges their beliefs. A humble investor constantly learns. They question their assumptions. They update their understanding. They remain flexible when new data appears. This mindset doesn't eliminate mistakes, but it prevents small mistakes from turning into disasters. It allows you to adapt while staying grounded. Another important mindset shift is taking responsibility for your decisions. Many people blame the news, the economy, their friends, or bad luck when things go wrong. But blaming does nothing. Responsibility does everything. When you take ownership of your financial outcomes, you stop making excuses and start making adjustments. You learn faster, you think deeper, you plan better. You develop the maturity required to navigate uncertainty. Responsibility transforms you from a passive participant into an active builder of your future. A long-term mindset is one of the strongest advantages an investor can have. When your thinking extends beyond weeks or months into years, you stop being controlled by temporary noise. You stop reacting emotionally to price fluctuations. You focus on the bigger picture, the growth of your portfolio over time, the strength of the companies you own, the trends shaping the future. Long-term thinking allows you to ignore short-term storms that frighten others. It allows you to stay on track even when the road becomes unclear. Confidence built on understanding, not on hope, is also part of a strong mindset. When your beliefs are backed by research, logic, and clarity, you don't panic easily. You don't second-guess your decisions every time the market moves. You stand firm not because you're stubborn, but because you know what you're doing. This type of confidence grows from learning, studying, and educating yourself continuously. The more you know, the less the market can intimidate you. In the end, investing success starts with you. Markets will change, but your mindset must remain steady. Strategies will evolve, but your discipline must remain consistent. Predictions will come and go, but your patience must stay strong. The power to build wealth doesn't begin with the assets you choose. It begins with the mindset you bring. When your mindset is strong, your future becomes stronger. When your mindset is weak, even the strongest market cannot save you. In the end, the decision to invest in 2026 won't be defined by the noise of the headlines, the predictions of economists, or the panic of the crowds. It will be defined by something far more powerful: your clarity of judgment, your willingness to think independently, your refusal to be rushed, pressured, or hypnotized by the illusion of easy wealth. Because the truth is simple: every market cycle tests people, but only those who prepare, who study, who remain patient, emerge on the other side not just richer but wiser. The world is heading into a time where emotional discipline will matter more than strategy, and where understanding risk will matter more than chasing opportunity. So before you put a single dollar into 2026, strengthen your mind, sharpen your decision-making, and train yourself to stand calm while everyone else is trembling. Wealth does not come to the fastest, it comes to the most prepared. If you understand the principles we've discussed, rationality, patience, simplicity, humility, and long-term thinking, then the future is not something to fear, but something to build. You don't need luck. You don't need perfect timing. You need clear vision. You need discipline. You need the courage to act when the moment is right, and the wisdom to wait when it's not. Because the greatest advantage you will ever have is not in the market. It is within you. So as you step forward and prepare for the opportunities ahead, remember this: wealth is earned by those who think when others react, who stay grounded when others gamble, and who commit to learning long after everyone else stops. If you can hold on to that mindset, then no matter what 2026 brings, volatility, uncertainty, or change, you'll be ready not just to survive it, but to master it. And that is how true investors are made.